Hey everyone, welcome back to Corporate Decoder. Today, MediaAlpha Incorporated ticker symbol M.A.X just filed their quarterly report, and I'm seeing some seriously interesting shifts in how they are making money and spending it. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report shows a big jump in revenue, but also some significant changes in expenses that are definitely worth digging into. So let's dive into MediaAlpha's financial picture for the quarter ending the 30th of June, 2026. First up, revenue. For the 3 months ending the 30th of June 2026, MediaAlpha brought in a whopping $316.9 million. That is a big jump of over 25% compared to the same time last year. Where is all this money coming from? Mostly from their property and casualty insurance business. This sector brought in nearly $309 million, which is almost 36% more than last year. This is thanks to insurance companies spending more on advertising to find new customers, especially as they are seeing good profits. However, their health insurance business is shrinking. Revenue dropped significantly by almost 85% compared to last year, bringing in just $2.7 million. This is because MediaAlpha decided to reduce its focus on the under 65 health insurance market. Now, let's look at the cost of generating that revenue. Their cost of revenue went up by about 27% to $271.7 million. This means that while they made more money, it also cost them more to do so, mainly because they had to pay more to their partners who provide the insurance leads. Things get really interesting when we look at general and administrative expenses. These costs dropped by a huge 70% down to $14 million. A big reason for this is a massive decrease in legal costs. Last year, they had to set aside a lot of money for a legal matter with the FTC, about $33 million. This year, that big expense is gone. And speaking of other income and expenses, MediaAlpha reported a massive other income of nearly $38 million. This came from a gain they made by buying back part of their tax receivables agreement. Basically, they paid off a debt for less than it was worth on paper, pocketing the difference. With all these changes, especially the big gain, their income tax expense shot up to $13.3 million compared to just a little over $300,000 last year. They are paying a higher percentage of their profits in taxes this year. All these factors combined led to a net income of $41.8 million for the quarter. This is a huge turnaround from a net loss of $22.5 million in the same period last year. Looking at the share count, the diluted weighted average shares outstanding increased quite a bit to over 62 million. This is likely due to stock grants or other ways they issue more shares over time, which can dilute existing shareholders if not managed carefully. Let's zoom out and look at the first 6 months of the year. Total revenue is up significantly by over 21%, reaching $626.9 million. Again, the property and casualty insurance sector is the main driver here. Interestingly, last year they had a large write-off of intangible assets, about $13.4 million. This year they had no such write-offs, which is a good sign that their acquired assets are holding their value. Total costs and operating expenses are up, but by a smaller percentage than revenue, which is generally a positive sign for profitability. For the first 6 months, MediaAlpha recorded a net income of $50.9 million, a huge improvement from a loss of $20.7 million in the same period last year. Looking at their non-GAAP metric adjusted EBITDA, it also shows strong growth, increasing to over $60 million for the first 6 months of 2026 compared to around $53 million last year. This metric helps show the underlying profitability of the business before some accounting adjustments. Their contribution margin, which shows how efficiently they are making money from their core partnerships, stands at 15.3% for the first 6 months of the year. While still positive, it is a slight decrease from last year, suggesting some pressure on their margins as revenue grows. On the cash flow front, operating activities provided about $41 million for the first half of the year. This is a bit lower than last year, mainly due to changes in how they manage their working capital, like accounts receivable and payments. Financing activities, however, show a significant outflow of cash, over $63 million. This is largely due to them buying back their own stock and making a large payment related to that tax receivables agreement we mentioned. They also recently updated their credit facilities, taking out a new $150 million term loan and a $60 million revolving credit facility. This shows they are actively managing their debt and borrowing capacity. The company's dealings with the tax receivables agreement continue to be a major story. They paid off a significant portion of their obligation related to Insignia for $31 million, which resulted in a large gain for the company. This suggests they are working to simplify their financial structure and potentially reduce future liabilities. Now, while the financial numbers look strong, MediaAlpha does highlight several risks. they are still reliant on a few key partners, and changes in laws and regulations could impact their business. Plus, they are very dependent on internet search companies for traffic. From a corporate governance perspective, their management has stated their disclosure controls and procedures are effective, meaning they believe they are properly reporting important information. It is also worth noting that MediaAlpha has been actively repurchasing its own stock. They bought back over 2.3 million shares in the last quarter for around $21 million. This can be a signal to investors that management believes the stock is undervalued. My take overall, MediaAlpha is showing a really impressive turnaround in its financial performance. Driven heavily by the booming property and casualty insurance market, the big gain from settling that tax receivables agreement, and the reduction in legal expenses significantly boosted their bottom line this quarter. However, the shrinking health insurance business and the slight dip in contribution margin are points to watch. They are also actively managing their debt and buying back stock, which are generally positive signs. The biggest risk I am watching is their heavy reliance on a few key partners and internet search engines. If those relationships sour, or if new regulations hit the advertising and insurance spaces, it could quickly change the picture. What I'm actually looking for is how they continue to grow their revenue while managing those costs and partner dependencies effectively. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives.